Hello and welcome to the AIM Summit webinar on SPAC to the Future, Wall Street's hottest product. I'm your host, Zachary Seferati, CEO and founder at Dalma Capital and strategic partner of AIM Summit. We have so many people joining us today from all over the world. We have over 43 different countries participating amongst your institutional investors, family offices, high net worth individuals, and many leaders of the financial services industry. Please feel free to submit your questions at any time as they come through the Q&A dialogue down at the bottom of your screen. We will be addressing those questions at the end of the session, which will be moderated by my colleague and friend, David Gibson-Moore. And if you're joining us via YouTube, please like this video and subscribe to our YouTube channel now. Also, be sure to sign up at aimsummit.com so that you can be part of the live sessions and join us in the Q&A. Introducing our webinar partner today, Diginex. Diginex is a NASDAQ-listed digital assets and financial services company focused on delivering a cryptocurrency and digital assets ecosystem offering innovative product and services that are compliant, fair, and trusted. The group encompasses cryptocurrency exchange equos.io, as well as an over-the-counter trading platform. It also offers front-to-back integrated trading platform called Diginex Access, a securitization advisory called Diginex Capital, and market-leading hot and cold custodian and DigiVault funds, as well as funds business called Bletchley Park Asset Management. Introducing our other webinar partner today, which is Gulf Analytica. Gulf Analytica offers advisory services to companies wishing to develop their business in the Middle East, particularly in the Middle East regional markets, UAE, Saudi Arabia, and across the region. The particular focus has been on promising regional startups, especially in the fintech and healthcare sectors. The CEO and president of Gulf Analytica is our moderator today, David Gibson-Moore, who is a dear friend and colleague and has been an advisor of mine for many years. Thank you again, David, so much for joining us. It's such a pleasure to have you moderating this session. David operates Gulf Analytica, a financial services consultancy based in Dubai, but he also holds a number of other senior board positions at various financial institutions. He has extensive career experience from general management at GM to the chairman level at banks in Switzerland, Luxembourg, and other European jurisdictions, much of this time having been spent with JP Chase. He has extensive experience in investment banking, international loan syndication, project finance, and private equity in London and New York, creation of private banking networks in the US, Europe, and the Gulf, and institutional sell-side experience with major funds, including sovereign wealth funds and multilateral funds in the Middle East and Asia, including China, and several other jurisdictions internationally. He also has extensive experience in Sharia-compliant banking and investments gained principally in Kuwait and Saudi Arabia. He graduated first class with honors in chemistry at Oxford University and qualified as a chartered accountant with PricewaterhouseCoopers, and holds an MSc magna cum laude in financial economics at the University of London. David, again, such a pleasure to have you with us today. I'm going to hand over to you to introduce our other speakers and kick off our discussion today on SPAC to the Future.
Thank you very much, Zach, and good afternoon, good evening to you all. It's very good to be with you to discuss this very interesting topic. I think special purpose acquisition companies, or SPACs, have generated a lot of attention in recent years. And these so-called blank check companies have gone mainstream. And we've had this year 55 SPACs in the US, raising some $24 billion. Of course, the Wall Street banks are jostling to get in on this new trend. It seems to be an ideal solution for a company wanting to gain a public quotation fast. However, like many other financial products, the SPAC is also not without its criticisms. So it gives me great pleasure to be able to discuss these issues with two most expert practitioners. Firstly, we have Michael Schwartz, who is a leading New York-based capital markets lawyer. Michael represents US and international issuers, private equity and hedge fund sponsors, REITs and underwriters in public and private finance. He's represented issuers and underwriters in numerous SPAC offerings, including Ajax One in its approximately 800 million initial public offering, and the underwriters in the IPOs of Equi Acquisition Corp, Altamar Acquisition Corp, L&F Acquisition Corp, and others. Michael represented Morgan Stanley in a first of its kind, so-called Stakeholder Acquisition Corporation. This we're going to discuss a little bit later, but it was an initial listing by Health Assurance Acquisition Corp. He has worked on numerous high yield and investment grade debt offerings, IPOs, spin-offs, and other public and private equity and equity hybrid security offerings. Thank you for being here, Michael. And secondly, it's a great pleasure to introduce Chi-Won Yoon, Chairman of Diginex. Chi-Won has 3 decades of financial services and listed company experience. Chi-Won currently serves on the board of Hyundai Motor Company and previously served on the executive board of UBS AG. During his 22-year tenure at UBS, Chi-Won served as president and CEO of UBS AG Asia Pacific and was a member of the UBS Group Executive Board from 2009 to 2015. He oversaw the entire bank in 13 countries around the region and was responsible for UBS's 3 main divisions: investment banking, wealth management, and global asset management. Chi-Won also held various positions, including Hong Kong country head, head of equities, and head of Asian securities in Asia Pacific. And he established UBS's equity derivatives business in Asia. Thank you indeed, gentlemen. Now we will first discuss SPACs from the legal and technical side with Michael Schwartz. We will then discuss with Chi-Won Yoon how he views the challenges, opportunities, and even the potential pitfalls arriving from Diginex's own very recent journey through to flotation on the NASDAQ using a SPAC vehicle. So Michael, could I start with you? You're based in New York. Could I ask you about Skadden Arp's involvement in SPACs a little bit? How long have you been focusing on this business, and what sort of team do you have to tackle the challenges?
Yeah, so Skadden has actually been practicing in this space for about 20 years. We've been involved basically from the beginning. And so we've really seen this grow from something that was a little bit of a niche product to really something that's exploded this year to really mainstream. And we're seeing, David, all kinds of really high quality sponsor groups get into the business of SPACs. And they're really spanning all kinds of types of sponsors, from high quality private equity shops from Apollo to companies. In fact, I've got one that is one company called CBRE, which is the largest real estate company in the world, that is hoping to actually launch their SPAC IPO this week. So you're really seeing SPAC sponsors spanning the gamut of from all, really all walks of Wall Street.
Right. Just to sort of start our discussion before we get deeper into the model, could we just look at the basic SPAC? I mean, you start off with shareholders and cash held in trust,
yep,
and a private company with some assets owned by their shareholders.
Sure.
You just walk us through the transactions that take place, and I'd be particularly interested for you to track for us the journey of the cash held in trust supplied by the original shareholders of the SPAC.
Yeah. So I'll give you the life of a SPAC. It begins in the IPO phase, where the sponsor will form the SPAC. and the sponsor will provide two sources of capital. They will put in $25,000. That will give them the 20% interest in most SPACs called the promote. That's where really the juice is for the sponsor. And then they will put in the at-risk capital. That's usually put in the form of a warrant. And then they will go out and do the IPO, and that's where they will sell typically a unit. The unit will be a common share and typically a fraction of a warrant. And then the money that's raised in the IPO will be put in a trust, and the trust will be ultimately the money that's used in the acquisition, known what you typically call like a de-SPAC transaction. During the period when the sponsor is out looking for the transaction, the warrant and the common stock do trade separately. So a lot of times the investors in the IPO will trade the stock and hold the warrant. When the sponsor finds a acquisition target, investors have the opportunity to make a redemption in connection with the acquisition. So they get to decide not only to vote on the whether they want to approve the transaction, but they also get to decide whether they want to redeem their stock. And this is often a very valuable option for the IPO investors, because they get to decide at the de-SPAC transaction whether they like the target that the sponsor has found, but they also get to keep the upside because they get to keep the warrant. And that's often very valuable to the stockholders.
Thank you very much. I guess, some of the attractive features for the company being merged is the availability of management teams, finance, having growth in place, often a built-in institutional investor base. Could you quickly highlight the key factors making SPACs listing of interest? Yeah.
So there's been a lot of focus in the US about the IPO process, and there have been some focus on direct listings. And I think one of the key aspects that a SPAC brings that's a little bit different than the traditional IPO is price certainty. So in a traditional SPAC, the target will negotiate with the SPAC sponsor the price at which the pre-de-SPAC holders of the target company that they will receive. So they will lock in that price. Now, one thing that makes SPAC M&A, I think, a little bit different than a traditional private equity or strategic M&A process, a little bit different, is in private equity M&A, strategic M&A, you don't really have to justify a public market price. You can just negotiate a price, and it is what it is. And the acquirer, if they're happy with that price, then that's sort of good enough for them. But ultimately, in the de-SPAC process, you have to make the deal work. And what I mean by that is, in order for the de-SPAC transaction to be successful, the stock has to trade above the trust value. So we already talked about the fact that the IPO proceeds go into a trust. And the trust, in the old days when interest rates were essentially above zero, used to actually earn some money. But in order for, because of this redemption feature, the IPO investors have to believe that the stock of the de-SPAC company will trade above the trust value. And one point I didn't make was that the IPO unit is always sold at $10 per share. So, so the de-SPAC company has to be able to support a public market value above $10 per share. It's usually a little bit higher. We usually tell people that you have to be able to support a stock price around $12. If your de-SPAC company will not support a $12 per share public market value, it's more than likely that your de-SPAC transaction is not going to succeed. And that's very different than I think other M&A processes. So, and what going back to your question, David, I think you get price certainty, which is different in an IPO process where you go out and you market your company first, and then that's how you establish the price. So for the pre-IPO holders, you get that. The second thing is you often can get a little bit more cash up front. Often in a de-SPAC transaction, in addition to the cash that's held in trust, you would also have potentially a pipe that goes along with the de-SPAC transaction. And that pipe can be a very valuable way to add additional cash into the process to get the pre-de-SPAC holders additional cash.
Right. Thank you very much, Michael. When we were discussing things the other day, I know you felt that the recent comments by Clayton, the SEC chairman, concerning the SEC's increased focus on SPACs, as well as the recent interest from plaintiff firms in the US in the so-called de-SPAC process, were of interest. Could you comment on this a little bit?
Yeah. So one of the reasons that SPACs have really come into focus, both I think for sponsors and as well as the media and market participants, is because the economics are really incredibly rich for sponsors. As I mentioned, the sponsors will pay $25,000 for a 20% equity interest in the company. And that is a very powerful economic incentive. And the thing that really makes this very economically attractive to the sponsors is that 20% interest often creates some misalignment, because if ultimately the de-SPAC transaction is not as successful as everybody hopes and the stock trades down below that $10 price, the value of that 20% interest still is still very valuable. So even if the stock trades down to like $7 or $8, it's still quite lucrative for the sponsors. And I think that people don't always appreciate how the sponsor economics work. And I don't think they always appreciate some of the dilution that creates for investors, as well as some of the dilution that comes in related to the warrant piece. And I think Chairman Clayton's focus is on increasing disclosure around the sponsor economics. Now, related to that has been the focus by the litigation bar here in the US, which has largely left SPAC M&A alone. As many of the folks listening here today may know, deal M&A litigation has been prevalent here in the US for a long time, but for whatever reason, the plaintiff's bar has left SPACs alone. But that's changing, I think, very significantly this year. And plaintiffs' firms have really started to focus on SPACs. And one of the things they're focusing on is conflicts. And so I think they sort of go hand in hand, where the economics of the sponsors and the conflicts that are created by that, and I think will go kind of tied with the plaintiff's focus. So I think what we're recommending to clients is more disclosure up front in the IPO, and then when we get to the back end with the merger proxy, just being very, very transparent and trying to make sure the disclosure is pristine on the conflicts to try and heat off any plaintiffs' firms that might be lurking out there. So that's why I really think the two of them are intertwined.
Thank you very much, Michael. It is interesting. I mean, I was just looking at some statistics, and particularly the facts of the deal that was led by Michael Klein through Churchill Capital for Clarivate, which is frankly a little known data analytics company in 2018. And they put in their 25,000 for a 25% stake in the SPAC. And today they're sitting on 400 million worth of assets. I mean, this is, indicative of the type of magnitude of distortion. But I think also we have to qualify it by the fact that quite a lot of deals in the SPAC world don't come off. And I think the statistic is 2/3 of the vehicles that found targets were trading below the $10 IPO price.
Yeah, I mean, some of that has to do, I think, with some of the dilution that is sort of inherent in the product, right? I mean, the sponsor promote does create some of that dilution. But I do want to caution listeners, because the 20% promote, it's almost, it's like a kitty that can be used to make the de-SPAC work, so to speak. And oftentimes it's used by sponsors as a bargaining chip to help incentivize and juice the returns for the pre-de-SPAC holders. It can be used to build an RSU pool for employees. And so it's not often that the sponsors can keep all 20%. And oftentimes there's a direct correlation between what percentage of that promote the sponsor keeps and how successful the deal is. So we often do counsel clients to, just think about that as capital that they can use as leverage to kind of build a successful de-SPAC transaction. So that's one point. And the warrants are also a source of dilution in the product. And I don't want to sound so negative here. I mean, like a lot of financial products that are out there in the market, the SPAC isn't for everybody, but it is a very valuable tool for people where it makes sense. And so for people who really understand the product and can make it work for them in their particular situation, it's great. But I think for people who don't understand the product, then maybe it doesn't work out as well. So I think it's important that people who are looking at SPACs and people who are thinking about it, have the right advisors and really try to dig into the particulars and make sure that this is really the right product for them, because ultimately this really is a financial product.
Right. I want to move over to Diginex shortly, but if we just quickly, Michael, the product is evolving, isn't it? We've already touched on the stakeholder-aligned initial listing vehicle that you were working on. Could you very briefly tell us about some of the variants in that basic SPAC structure that you're coming across now?
Yeah. So as you mentioned, the sale structure that we developed, I mean, what it really is focused on is trying to address some of this maybe misalignment between the sponsor and the investors, and what the sales structure is. And there's another structure in the market called CAPS. It's trying to mimic the private equity carried interest structure, where the sponsor's promote is really tied to the performance of the stock. So it really looks just like a private equity promote, so that if the stock price achieves certain hurdle rates, the sponsor will earn additional common stock based on achieving hurdle rates. And I think people are trying to be creative. Again, whether that's a great idea or not, I think remains to be seen. It's attractive to certain targets, it's attractive to certain issuers, but because the sponsor promote is this lever that one can pull in the de-SPAC transaction to make the de-SPAC transaction work for this capital market, for the public markets. I think it remains to be seen whether putting in these alternative economics up front, it remains to be seen whether that's going to be a great idea or not.
Thank you very much indeed, Michael. I'd now like to switch the conversation, if I may, to discuss how the process appears from the point of view of a company actually handling and going through this journey. I should add, Michael will be available, of course, for any questions at the end of our discussion. So it's a great pleasure, as mentioned at the beginning, to have with us this evening Chi-Won Yoon, who is the chairman of Diginex, to discuss Diginex's SPAC journey through to a NASDAQ quotation slightly earlier this year. Chi-Won, could you just briefly tell us a few words about Diginex? Firstly, it's a digital asset financial service and advisory company. Could you just briefly tell us a little bit more about your company?
So Diginex really is a blockchain fintech company that offers a whole financial services ecosystem for digital assets. We have a crypto exchange in Singapore under the supervision of Monetary Authority of Singapore. This exchange was officially launched in July this year. We also have a custody business. It's called DigiVault, based out of London, where we can safekeep your digital assets. And we have a capital markets business, which provides enterprise solutions to clients. In other words, we use blockchain technology to solve real world problems. So our vision as a company is to bring digital assets to mainstream finance. We see our mission as bridging the gap between the crypto community and traditional finance. And we really aim to do this by focusing on security, compliance, fairness, and innovative products. And we believe that our operating philosophy of sort of transparency and fairness in this space will offer a truly differentiated platform. So now, as the first crypto exchange to be listed on NASDAQ, we believe we're in a great position to execute our mission.
Absolutely. Thank you very much. Diginex was founded in 2017. That's not very long ago. Could you tell us about the fundraising journey up to this SPAC point in time?
Sure. Prior to the SPAC listing, the company had a few private fundraising rounds from mostly family and friends, and a few small institutions like family offices and small asset managers. So our shareholder base was quite broad and diverse. We were originally scheduled to go with our SPAC listing back in March this year, but we had to postpone the deal due to COVID-19. So in the interim, we also had a small CB raise to tide us over, and the CBs were ultimately converted into shares of Diginex upon listing. So we had altogether 2 private rounds, 1 CB round before the SPAC listing.
Thank you, thank you. And I guess after those capital raises, the options on the table must have frankly been further private placement round, a conventional IPO on one of the major international stock markets, perhaps even acquisition by a larger organization, a bank perhaps, or the SPAC route. What made you choose the latter?
Sure. It's an interesting story, but our journey toward a listing began in early 2019. Around that time, the crypto market in Japan was very hot, and we had active discussions with a few Japanese banks for listing on the Mother's Board in Japan, which is one of Tokyo Stock Exchange's sections. where shares of startup companies are listed and traded. The timeline for the listing back then, we were told, was about 24 months. And theoretically, it could actually be longer if we wanted to come to the market at a reasonable valuation, because we needed to establish some form of a track record, if you will. We then were approached by a US listed company for an acquisition. We decided really not to progress that discussion too far, given that that company was a loss-making operation. Now, around July 2019, we learned about SPAC listings on NASDAQ. Our leadership team was immediately attracted to this alternative because we always wanted to launch an institutional quality regulated exchange that operated to a very high standard. And NASDAQ listing offered global recognition and credibility. So they discovered that SPACs are more efficient and completed quicker with a lighter regulatory touch than traditional listing, but obviously still have the same reporting and governance requirements. I think what pushed the leadership team over the line was that SPAC listing could be completed very quickly. We were told initially that the listing could be completed within 6 months. And we felt that being the first crypto exchange to be listed on NASDAQ would provide unique credentials and offer strategic advantages. So over the summer of 2019, we started to prepare for the SPAC listing.
That is very interesting. Thank you. Now, you must have had a number of options as far as partners concerned. How did you choose the SPAC you ultimately partnered with?
Yes, once the decision was made to proceed with a SPAC listing, we had a beauty contest, if you will, and the leadership team met with a handful of SPAC sponsors. We narrowed the choice by looking for a SPAC with Asia-based investors with the ability to acquire a fintech company. And since our exchange was based in Singapore and aiming to be regulated by the Singapore regulators, we thought a SPAC established by a Singaporean management team or a Singaporean sponsor and supported by Singapore investors would be helpful. So ultimately, we decided on 8i, a Singapore-based SPAC organizer.
Yes, I see. And of course, that was a US SPAC. But did you consider partnering with a SPAC in any other jurisdictions? I mean, Hong Kong, for instance, would have been.
Yes, absolutely.
London, say?
Interesting. As I understand it, variation of SPAC structure is available in London Stock Exchange. But we were not approached by any SPACs outside of the US, if you will. And as a fintech firm, NASDAQ was a very attractive choice for us. I mean, it is the leading technology exchange in the world with many household tech firms listed there. So, and we also believe that having regulators like the SEC vetting our business model would give us additional credibility. So once we decided on a NASDAQ listing, we didn't look back. We just kept on going forward.
That's, I'm sure, yeah. I mean, now you've been through the whole process. What were some of the key observations, perhaps unexpected, that you encountered during this listing process?
Sure. Yes, I mean, I think as a management team, it's really important to maintain flexibility and agility in order to navigate the many different mechanisms that drive a SPAC listing. Now, as I mentioned earlier, while SPACs are regarded as a quicker way to list, that is not always the case. And the time and the effort required to file the relevant documents with the SEC should really not be underestimated. There are also time constraints as to how long documents remain effective. So documents need to be refiled or re-reviewed and approved by the SEC if they go stale. And that also incurs additional costs, right? So for Diginex, As I mentioned earlier, the preparation began in July 2019. We were ready to go live in March of this year. So it took us around 9 months to go with the process. Unfortunately, March 2020 was when COVID was really beginning to spread around the world and the markets were very volatile. So we delayed the listing. We waited through the summer months and pulled the trigger and went live in September. So from start to finish, it took us 14 months to complete the listing. It was longer than the original estimate of 6 months, but shorter than the IPO estimate on the mother's board of 24 months. Now, when it comes to sort of lessons learned, I would say that I was new to SPACs. I mean, I was a banker for many years, but this was the first SPAC that I'd come across. Most of Diginex shareholders and SPAC investors in Singapore were also quite new to the process. So maintaining active dialogue with the two different shareholders on both sides to ensure that they understood the process was really important. Now, I think this is a really important point. From the company's point of view, you don't know when you will list or how much money you will raise from the listing until the very last minute. In fact, you officially don't know whether or not the listing is going to happen until the SPAC shareholder vote takes place. And as Michael mentioned earlier, because the SPAC investors are able to redeem until the very end, the ultimate cash and shares on issue in the SPAC was only known 2 days before the SPAC shareholder vote to us. And this was literally about 2 weeks before the actual listing date. So you're working for, 9 months or 14 months, however long it takes. You only know in the last 2 weeks before the listing how much you're going to raise. So I think that uncertainty of whether or not you're going to list oftentimes made it difficult to engage with, let's say, sell-side research. And also, if we wanted to initiate marketing campaigns, most marketing shops would say, you should wait until you list before you actually start a marketing campaign. So I think all those facts meant that you just have to move very quickly at the last minute. One last point I would make is that because many of our shareholders have lockup periods between 6 months to 12 months, there's only a very small amount of free float today. So we have something like 30 million shares outstanding, but the free float today is only about 2.7 million shares. So it's less than 10%. So it means very limited liquidity on the stock right now. We are obviously trying to change that. Clearly, the other shareholders' liquidity will improve. I think over the next couple of weeks, another batch of locked up shares will come to market, and that will improve liquidity. And we're also doing a strategy, or we did a strategy day or an investor day at the end of or middle of November to really attract additional investors. Sorry, that was a very long-winded answer, but I was trying to...
An excellent answer, thank you. How did you find during this quite tortuous process the challenge of communicating with shareholders to understand all the twists and turns of the journey you were taking?
Yes, it really took a fair amount of effort because the SPAC investors, not all SPAC investors come in with the intention of really participating in the IPO, right? Or in the merger, if you will. And so, some of them were there because they really had no interest, but they could actually get warrants or rights by being there, even if they redeemed. Furthermore, for most of us in Diginex side, we were more familiar with traditional IPO type settings. So it was a real learning experience for all of us, but I'm glad we actually got it done. And, I think we're off to the races now.
Thank you. Well, you mentioned the sell side just now. Mm-hmm. What's been the key feedback from the sell side regarding the SPAC issue? And thinking about things like market research and feedback from sell-side analysts and so on?
Sure. I think, as I mentioned earlier, I think it was somewhat challenging to engage with sell-side analysts from traditional Wall Street firms prior to the listing. The common feedback we received was, please list first, build your business. Once the business reaches a certain size, then we can have a look, right? But one positive thing about SPACs is that you can engage in company-sponsored research, which in traditional IPOs, you're not allowed to do, or you're unable to do that. So we engaged a company to initiate coverage on Diginex in early September. And I'm told that it's actually issuer paid research is quite common in the SPAC process for small cap companies in a new sector like ourselves, because we're the very first crypto exchange to be listed, right? But since the listing, I would say the feedback from sell-side analysts have been very positive. The interest is not necessarily from the bulge bracket firms, but the next level down. And as I said, the first crypto exchange to be listed on NASDAQ is attracting a fair amount of interest. And we have been invited to a lot of conferences and roadshows. So we seem to be making good progress on that front.
Well, that's very good. Looking back, is there anything you would have done differently?
Oh, yes. I suppose there are always lessons to be learned in any process. But I think I'd like to maybe just highlight a couple points. One is really to do your homework and fully understand the structure of the SPAC and the future business model. And I think Michael mentioned this earlier in his presentation. The SPAC listing process for us took a little bit longer than we anticipated because we're learning as we were going along. And Diginex was initially advised to list as a domestic issuer. And upon further review, we changed our mind and decided to list as a foreign issuer, which obviously cost time and money and ultimately delayed our listing. The other point I would just mention is you have to choose your service providers carefully and understand the scope of activities that they will provide during the listing process. Now, as a banker who grew up in bulge bracket firms, I was very used to sort of the full service model of a broker providing research, roadshows, fundraising, and extensive post-listing advice. But I found that the SPAC community has a much more limited scope of activities. Many are small firms with limited resources and very specialized expertise. So we had to do some of the work ourselves or engage other specialized firms to help with the process. Now I'm told that larger firms are getting involved and they're offering much more of a full service offering. So I'm sure the sector will develop further in the future.
I guess being part of the crypto sector, this is a sector that's had traditionally transparency and corporate governance issues in certain cases.
Yes.
And although being a quoted company now does involve a lot of extra regulation related activities, it's an incredible achievement and allows you really to stand out amongst your competition, frankly.
Thank you. Thank you.
What would be your advice for any public company, private company considering taking the SPAC route?
I would advise them to really understand the pros and cons of a SPAC listing and make sure you're pursuing the SPAC route for the right reasons. Then I think it is important to find the right SPAC sponsor, a partner. Ideally, your business interests should be aligned and you should have a healthy working relationship between the two parties. So obviously you'll be working very closely to complete the business combination. As I mentioned, the mechanics of a SPAC listing is quite different from a traditional IPO. And it's really important to understand the differences early on and prepare accordingly. Finally, I think it's also important to fully appreciate the operational differences and additional costs that come with a listed company. You know, your governance structure has to change dramatically as you transition from a private startup to a listed company. Your decision-making process, the establishment of a board with independent directors, your corporate communications and marketing strategy now has to be very carefully coordinated. Your internal staff training around what you can or can't do or say, all has to operate to a higher standard, right? So, and now on top of that, you have to also bear the cost associated with all of the above. So in short, you have to begin, I think, with an end in mind. Make sure that the end of the business combination, that at the very end of that, you are getting what you bargained for. If I had to do it all over again, I think we would still choose a SPAC listing. It's true that we encountered some challenges and delays, but we still completed the merger at the end of September this year. And we achieved our objective of being the very first crypto exchange to be listed on NASDAQ. And as you mentioned, David, for a sector that has transparency and corporate governance issues, I think we are now sort of regulated by the SEC, and that gives us additional credibility. And it gives us a chance to becoming a leader in this regulated license space. So that would be my advice.
Well, thank you very much. I've just one last question before we move to some of the questions that we've got on the question section. What are your future plans now? Any further capital raises? You probably won't be the only crypto exchange quoted on NASDAQ forever. How do you see that situation?
Yes, no, that's very true. I mean, we hear that there are many other crypto exchanges, already very well established ones, also looking to list on NASDAQ or other exchanges. So yes, we want to take advantage of this unique opportunity, unique credentials that we enjoy at the moment, and try to scale up faster than we're doing organically. So yes, I think we could think about some sort of a fundraise down the line. And as Michael mentioned, I think a lot of these SPACs actually do secondary offerings or other fundraisers shortly after the listing. So it wouldn't be unusual to do that.
Well, thank you very much. We have got some questions. I've got one that I think is probably for Michael, first of all. It's from Riaz Sadiki. Thank you, Riaz, for the question. What are the smallest companies that a SPAC is an appropriate vehicle for?
Sure. I think, as I mentioned before, it's one that you have to keep in mind. You have to be able to support the public market price of greater than the trust value. So it's one that's got to be able to support that, what I'm calling that $12 market price. So if you think about, what company would be kind of IPO eligible, that's really what you should be thinking about as like, what's the smallest company that would be eligible for a SPAC. So I don't know what the exact dollar amount is, but as you think about what kind of companies would be eligible for a SPAC, you have to think about what kind of companies are really public market ready. That's really, I think, what the standard is.
Okay, thank you. Another one, if I could ask you, is there a good resource where all necessary information on launching a SPAC is organized? Legal, SPAC, economics, etc. I know you've got these wonderful decks, actually, that I hope our attendees will be getting, but any other comments on that?
Yeah, so we've got, so David, as David mentioned, and they'll be made available we've actually got two presentations that really summarize very high level SPACs, as well as what we call the de-SPAC transaction, which I realize I'm not sure I really define, but what we call a de-SPAC, that's the business combination transaction. Sometimes called a SPACquisition, or but that's really the business combination transaction. And frankly, I think there's tons of great resources out there put out by just about every law firm. A lot of the big four accounting firms have put out great resources, and so there's a lot of great resources out there, including the two presentations we have, which really, in 4 or 5 pages each, really lay out at a very high level all the information that I think I don't know if it's all the information you need to know, but and we also have one of my tax colleagues wrote a great article, which I'd be more than happy to make available to everybody, really laying out all the tax analysis involved in SPACs. So David, we can make that available to folks as well.
Thank you, Michael. I've got one definitely for Chi-Wan from an anonymous attendee. Any exciting business updates from Diginex?
Yes, we have a very exciting. We have a very exciting roadmap for product rollouts. So we launched our exchange in July this year, and we were obviously very busy with the actual listing. Now that we are listed, we are going to be launching very interesting products. So if you're interested, please look at our website, and there'll be a lot of interesting developments in the coming months. It's been something that we've been planning for a while, and we want to sort of execute on a consistent basis. So I think it'll be a compelling set of products, which will make institutional type players very interested in this space.
Thank you. Well, that's very wonderful information. Another one for Michael here from Chilpa Chudari. Thank you, Chilpa. So someone wants to issue a SPAC. What's the amount of money that they need to invest for the IPO, and after till money is available from the SPAC? I guess really asking, how much money is involved.
Yeah. So the sponsor has to put up 2% plus $2 million. That's what the at-risk capital is. And that 2% represents the upfront underwriting fee. The underwriting fee in a traditional SPAC is 5.5%, 2% upfront, 3.5% on the back end. And that 2% upfront, that goes into the trust to make sure that the trust is 100% funded upfront. And then the $2 million, that goes to offering expenses and then the working capital that the SPAC uses essentially to sort of keep it operating during the period while it's trying to find an acquisition. And the truth is that that's usually not enough money to operate while it's looking for an acquisition. And so sponsors often have to put in a little bit more money, and they usually do it in the form of a loan that they can often get back during the de-SPAC transaction.
Right, thank you. I've got another one from an anonymous attendee. Is it expected that the sponsor put more money in at the IPO or PIPE stage?
Yeah, it's not expected. A lot of times they do. As I mentioned, when you get to the point of the de-SPAC, there's you need to make it work. I keep coming back to that, but it's important to get the deal done that ultimately it trades well. And so the sponsor is the person who's the most incentivized to try to make it work. So it's not uncommon for them, if it's necessary, to put more money in, but it's not expected But there are oftentimes sponsors who will put in additional capital at the time.
I see. Okay, thank you. I'm just going through. We've got one very long one here that I think is probably for you also, Michael, but I'll just, rather than going through the whole question, just sort of try and summarize it. This is from Nat Mani. We are looking at using a SPAC for a carve-out from a public company, as we believe that the asset on a standalone basis is worth more. And then it goes into some figures. In our hypothetical example, we're hoping to get the carve-out valued at 2 billion EV. And from what we have read, we would need to have a SPAC of 500 million. So the EV math of approximately 4 to 1 would work. Could you walk us through how this transaction could work, and also cash flows of the parent company and amount of shares they will own, and a PIPE if the sponsor needs additional cash, say another 250 million?
Yeah, I mean, I think basic math, which of course is the reason I'm a lawyer and not a banker, is because math is not my strong suit. But I think you're thinking about it right, which is we generally tell people that the size of the acquisition that you should look at would be roughly 4 or 5 times to 1 the size of the SPAC. So the math that you've laid out in your question, as David said, is kind of in the ballpark of what you should be thinking about. So you know, if you're looking at a $2 billion valuation, that's the size of SPAC you should be looking at. And then the PIPE, the PIPE really would be there to potentially do a little bit of potentially give you a little bit more cash, cash out some more of the pre-de-SPAC shareholders, and you know, also one of the things to think about would be the mix between SPAC cash and PIPE cash, because the more SPAC cash versus PIPE cash, obviously there's a little bit more dilution involved with a SPAC because of the warrants versus a PIPE, which there's usually no warrants involved. So that's another thing to keep in mind as you think about the mix between PIPEs and SPACs.
Well, thank you very much indeed. I think very sadly we're running out of time now, and I think we're going to have to finish our discussion. There's certainly a lot more aspects that frankly we could have discussed. I think, however, we did go through quite a lot of ground. We were able to look at the pros and cons of SPACs, both from the sponsors as well as the acquired company's point of view. And we looked at how the concept is really rapidly developing into some more complex structures. And I think it was incredibly useful and interesting to be able to go through the opportunities and challenges in real life faced by Diginex in its journey towards its SPAC NASDAQ quotation. I'd like on your behalf to thank very much Michael Schwartz and Chi-Won Yoon. It was incredibly useful to have your expertise, and I do want to repeat that there's these 2 decks that Skadden Arps have prepared that are really excellent, that I hope you'll all get afterwards. Please apply to the AIM Summit managers. Now, a couple of announcements. Please don't forget the extremely interesting AIM Summit webinar next Monday, December the 10th at 5 p.m. GST with Mohammed Al-Arian, the famed global market commentator. His webinar is entitled 2021 Investor Playbook, How Great Change Will Bring Great Opportunities for Traders. And this will be sponsored by Equity Group. And lastly, please remember, if you're joining us on YouTube, please like this video and subscribe to our YouTube channel right now. Thank you very much indeed. Thank you, thank you.